Good afternoon, everyone, and welcome to an introduction to Nadex knockouts. Thank you so much for joining us. Glad to have you here. Before I get started, by the way, in a quick introduction, my name is Todd Rich. I am with Nadex, just so you know who is sharing this with you. Before I jump into the session for today, which is a deep dive into knockouts at Nadex, I do need to disclaim this webinar, as are all of our webinars, are sponsored by our compliance department. Trading involves risk and may not be appropriate for everyone. Any trading decisions you make are solely your responsibility and at your own risk. And then most importantly, this is an educational session. Please do not construe anything I say as a buy or sell recommendation. I'm doing this for your education, and I'm telling you later in the session, we are going to do a very practical demonstration. We will be in our demo environment, but it has live markets. We're going to go through some examples. I don't want you to construe anything as I say as a buy or sell recommendation. I just need to demonstrate how they work and how our platform works. So with that, before I jump into that, I'd like to tee this up front. We're here to help you. This is really important. Email us, customerservice@nadex.com. Follow us on social media. I will specifically call out our YouTube channel. And in fact, I'm going to show you some really cool things that we're doing lately that you might not be aware of, but can certainly help you in your trading journey. I will show that later. But more importantly, this is an interactive session. I've got my colleague Sophie in the background. You can type questions in as I go. If I go over something too quickly, I'm not clear enough, whatever question you may have, there's a high likelihood that someone else has it as well. Please interact with Sophie. She is an expert and she's here to help. And so please, I will also take a look at those questions at some point to make sure that everything is getting answered. But if you have any questions as we go, please chat them into Sophie, she'll answer. Now, what is our agenda today? And notice I'm moving a little bit more quickly because I do want to get into this, and then I want to show you. So first, I am going to start off a little bit with who is Nadex. I like to do that with some of these sessions just so you become familiar with who we are and how we differentiate ourselves from other exchanges out there. Then I'm going to define knockouts. We're going to talk about what knockouts are, and then we're going to go through how they work. Part of how they work is understanding the risk, the reward, and any capital requirements in order to trade Nadex knockouts. And then, as I mentioned, I'm going to do a very practical demonstration. I call it the show me phase, the show and tell. My mom is from the great state of Missouri, or Missouri, however you want to pronounce it, the show me state. I find that a lot of times by simply going through some examples on the platform, it makes it very clear, very easy to understand. They're pretty intuitive when you see it that way, but we are going to go through a slide deck beforehand to sort of tee it all up. So let's start off with who is Nadex. Nadex is short for North American Derivatives Exchange. We've been around for about 20 years now. We are regulated. That is something that differentiates us from other, what I'm going to say are binary option exchanges out there. Our core product are binary options. I did a deep dive into binary options last week. If you missed it, the recording is on our website as well as on our YouTube channel, so you can watch that at your leisure. This session is also being recorded, which you would find there, but that is how we differentiate ourselves from other binary options providers, is we are actually regulated. We are regulated in the United States by the same regulator that regulates the Intercontinental Exchange, which owns the New York Stock Exchange, as well as the Chicago Mercantile Exchange, the CME. So we are regulated. A lot of the competition out there that you might see or have access to that is offshore is not regulated in the United States. And when I say that, I always like to toss out caveat emptor, buyer beware. If you get into an exchange that is not regulated in the United States and something were to go wrong, you wouldn't have any recourse. So that is one of the benefits of Oop, there we go. Sorry about that. That is one of the benefits to Nadex. By the way, if you're having technical difficulties, can't hear me, try refreshing your browser because sometimes this is being delivered over the internet, and refreshing your browser will help. So if anyone's having any problems, refresh your browser. All right, next up. We are regulated, and what Nadex did is we designed contracts for the retail trader, for the individual trader. So we've got binary options, again, which I covered last week. We've got knockouts, which I'm going to do this week. At a future session, you can catch the call spreads one. I like to do call spreads and knockouts a little bit together because they're similar but different. But the contracts that we have, because they are designed specifically for the individual trader. They are small notional value contracts. They have a low cost to entry, and everything on our exchange has defined risk, defined reward. And that is actually important. So they're all fully collateralized. So you know what you're getting into up front before you ever even place a trade, what you could potentially make and what you could potentially lose. There's no such thing as a margin call at Nadex. You'll never have that. All those other challenges you might have with other exchanges where they have very large contracts and you've got to put up performance margin and things of that nature. Nadex contracts are designed for accessing price action in those markets, but with very low dollars. Now, let's talk about what are knockouts. Okay. First up, a knockout is a contract that trades within a set price range. Okay, so a knockout is going to have two prices, and that price range, we're going to give you two prices for a knockout. There's going to be a low price, which we call the floor, and there's going to be a higher price, which we call the ceiling. So a knockout's a contract, it trades in this price range between the floor and the ceiling. And the value of the contract is what we call a delta 1 product. What that means is it will move exactly in line with the underlying market. So when you're trading Nadex knockouts, it's the same as any other market that you would be trading. If you think it's going higher, you would buy. And interestingly enough, if you think it's going lower, you can sell. Now, some people are confused by that. They go, how can I sell something I don't own? You're simply taking a position that the price is going to go lower. So you can either buy a knockout if you think the price is going to go higher, and the price of the knockout will move exactly in line with the underlying. And if you think the market is going lower, you can sell and profit if it goes lower, or you've got risk if it goes higher. All right, so that is a knockout, and it will trade between the floor and the ceiling. Now, how do they work? A knockout will expire in one of two ways. All right, it will settle in one of two ways, by price or by time. So let's first talk about a price settlement getting triggered. If the Nadex indicative index for that market, and we've got knockouts for indices, foreign exchange, and commodities, and I will show you all of that. If the indicative index for that market were to touch either the floor or ceiling, you would get knocked out of the trade. Right? It will settle. If the index hits the upper range, hits the ceiling, the contract settles. If it hits the floor, the contract settles. That is it. It would end, and that is called a price settlement getting triggered. So that's way one that it settles. Way two that it settles is by time. What if when you buy or sell a knockout, it does not touch either the floor or the ceiling? Eventually, there is an expiration time, and I will talk about that. They're all weekly, but it'll hit the settlement time, and that is the time settlement getting triggered. So it didn't touch either the floor or the ceiling, but it will settle at a price between those ranges at a certain period of time. So you've got a contract. It trades in a range between a floor and a ceiling. If it touches the floor or the ceiling, you're knocked out of the trade. That's why it's called a knockout. If it doesn't hit the floor or the ceiling by expiration, it will settle at expiration someplace between the floor and the ceiling. Now, I mentioned each of our knockouts. All right, it doesn't matter whether it's in the indices, and we've got all the U.S. indexes. It's a foreign exchange pair. We've got 8 of them, all the main pairs. We've got our commodities: gold, silver, oil, and natural gas. Each one of those starts off at the beginning of the week. We build knockouts for the week, and we will list 4 knockouts in each one of those markets. So in each market, you'll have 4 different choices, and the expiration, the settlement time is set for the end of the week. Now, over the course of the week, if either the floor or ceiling in one of the brackets or one of the knockout ranges is touched, that settles. Okay, now we've only got 3 of them. We'll list a new one so that there will generally always be 4 knockouts for you to choose from in each market. So we try to keep 4 always available to you. Now, let me give you a little example in the US 500, which is the S&P 500. And in this example, we just picked the level 2720, which is where it opens. And in our S&P 500, the US 500, all of these have a 50-point range, which means these contracts are each worth $500. Most of our knockouts are worth $500. Some of them are a little different. For instance, the NASDAQ, it's worth $600, but you can look at that in the product specs. But the way we do it is we take the market on where it opens, and we'll do a floor that's only down 10 points and a ceiling that's up 40 points to give us a 50-point range. Now, for the next bracket, it'll be, we still keep it 50 points wide. We take the market and we subtract 20 to create the floor. So the ceiling is going to have to be plus 30 and so on to have 4 brackets. So you see we have 4 different ranges that we're going to offer, and the market, that's the price level. That line you see there is where the market currently is. Okay, and that's how we build our knockouts. Now let's go through an example. And I forgot to mention, and then there is always a time. All right, there's always an expiration, some point in the future where these will expire and they will settle. Now let's go through an example where price triggers the settlement. All right, here we are. This is our example. We've started trading and the S&P opens and it starts trading higher. All right, now what happened? It went up a little bit, and notice bracket number 4, which is the one that had the lowest ceiling, it got touched. All right, so bracket 4, as the market started trading higher a little bit, bracket 4, that ceiling got touched and it expired. It settled. Boom. Anyone with a trade in bracket 4, that settled. If you had bought it, it went up, you're knocked out of your trade, you got a profit. If you sold it and it went up, you had a loss. Bracket 4 is now gone. And then we add a new bracket in the direction where it's trading. So we now have, once again, 4 brackets for you to choose from. Now, as time goes on, the price, let's assume the price had originally gone down. Okay, so instead of going up and triggering bracket 4, in this example, it went down. Now bracket 1 is the one with the highest floor. Notice that's got the highest floor, and bracket 1 got triggered and is now out. All right, so now you are knocked out on bracket 1, and we add a new bracket. So once again, you're back to having 4 brackets to choose from. And so we've given you a range, and you have to decide which one of these brackets best suits what you're looking to accomplish. And we are going to get into that. I just wanted to show you the mechanics of how we list 4 brackets on each product. And if as the market moves, a bracket will, if a floor or ceiling gets touched, that bracket is gone, and a new bracket is created so that you have 4. Now let's talk about time settlement. All right. Knockouts are actually considered variable payment, unlike binary options where it's always worth $100 and you can track the probabilities. A knockout, we don't know what the final settlement value is because, or I mean, the potential payouts. The potential payouts can be determined between where you buy or sell and where the settlement is. Now, when you buy and sell, if you touch one of the floor or ceiling, you know how much you can make if it were to touch a floor or a ceiling before you enter a trade. If it doesn't touch a floor or ceiling, it will settle at a point. So this is the time settlement, the time getting triggered. And in this example, all right, we've skipped ahead to the end of the week. And at the end of the week, we had these 4 brackets that existed. Notice bracket 1, 2, 3, and 4. And then we hit our settlement time. And in that period, the floor or ceiling was never touched in any one of these contracts. So all 4 of these brackets, these contracts are all going to settle, and the profit or loss that you would experience would be the difference between where you bought or sold and the final settlement price. In this particular example, since it was in a downtrend, it kind of looks as though, for the most part, if you had sold bracket 1, 2, or 3, and then it settled, for the most part, it looks like you made a partial profit. If you had bought, you would have a partial loss. So in the end, you can have a partial profit or partial loss that is somewhere in between the range of the floor and the ceiling. Whereas if you hit the floor or the ceiling, you would have maximum profit or maximum loss. On time, it'll be partial. So let's talk, let me just take a quick peek. Before we keep going on, I just wanted to see. All right, I think we're doing okay. I want to talk a little bit about the risk, reward, and capital requirements. And then we're going to jump over to the platform and we'll do a practical demonstration. In the risk, reward, and capital requirements. So everything, just like I mentioned at the very beginning of the session, Nadex contracts designed for the retail trader give you a known quantifiable amount of risk and a known quantifiable amount of potential reward before you enter the trade. That was a mouthful. I had a hard time getting that out. Let me take a sip here of some water. Sorry about that. So the way that we've designed these contracts with a floor and a ceiling, they give you natural profit targets with defined risk. So you can control your risk and you can have an idea of what your potential profits are. So the very structure of these products almost gives you a built-in trading plan. And this is why we offer knockouts. It's to help people stay disciplined. Being disciplined when trading can be difficult. A knockout is forcing you to be disciplined because it will have, if you buy or sell, it doesn't matter, you will have a very clear profit target. That would be your maximum potential profit. So you've got a profit target before you enter the trade, but you also have a very clear stop loss level if you are wrong. So your risk, your maximum potential loss is also shown to you so that you know, all right, how much am I willing to risk? How much risk am I willing to take? How much am I prepared to potentially lose? What am I looking for in regards to potential profits? And then you choose which knockout suits your trade, and the very construct of the contract itself forces you to stick with your trade plan in as much as if it touches the floor, ceiling, whether you buy it or sell it. Let's say you sell it and it touches the floor, or you buy it and touches the ceiling. You're going for your profit goals. But if you're wrong, your stop loss it went against you, you know exactly where you get knocked out, forcing you out of your position so you don't take any additional losses, thinking, I want it to come back or whatever it is. It's going to force you to get out when you hit your profit goal or take your stop loss if it goes against you. Now, in terms of the risk and reward, I just kind of want to show you an example, and this actually will play directly into what your capital requirements are. But if you buy a contract, the maximum risk that you're going to have is the price that you pay, the difference between the price you pay and the floor. So if I buy a contract, whatever price level that is, the most I can lose is if it goes down to the floor and I get knocked out. And that's actually a calculatable number. Now, on the flip side, if you sell, all right, I think the price is going down. I sell, my maximum risk is the difference between the ceiling and the price that I sold it at. I sell it and it goes up and it touches the ceiling. I was wrong. I sold it. It went up against me, but I can't lose anymore. If it touches the ceiling, I'm knocked out of the trade and forced to take maximum potential loss. On the reward side, let's talk about the fun part too. If you buy, all right, your maximum reward, potential reward, is the difference between the ceiling and your buy price. So you buy it and it goes up to the ceiling and you get knocked out at the ceiling. That's your potential maximum reward. You buy it and the maximum reward is the ceiling minus the price that you paid. Now, for the seller, it's the other way around, right? I'm selling it, and my maximum reward is if it goes down to the floor and it touches the floor. So it'll be the difference between the price that I sold at and the floor. Okay, so it's very clear. And by the way, we make this easy. We calculate that for you on the order ticket. Now, I want to show you an example on slides, and then we'll get into the platform and you can see it in action. But let's just take an example. Let's assume you think the US 500, the S&P 500, were going higher. You might choose to pick bracket 1. Now, why is that? On bracket 1, I'm buying, and if I'm wrong, it's going to have the smallest amount of risk and the greatest amount of reward. All right, so let's just take a look at what my risk and reward are. Here we are at the price level of 27.20. We know when the expiration is, right? The settlement time, it's at the end of the week. And I picked bracket 1 where the floor is 27.10 and the ceiling was all the way up at 27.60. Just a very easy way to visualize it. If I bought right here at 27.22, all right, and I've got my floor and my ceiling, the most I could lose is if it goes down to the floor, and that is a known amount. Now, my maximum reward, hey, look, it goes all the way up and it touches 27.60. So that is how I'm able to see my risk versus my reward. Now, depending upon where you bought or sold, or that level in the middle that separates the green from the red, if I were to buy a little higher, my risk would be a little less. I mean, my risk would be a little bit more, but my profit would be potential profit would be a little bit less. So that line across the middle between the red and green could slide up and down. Let's take a look at a sell example. I think instead of thinking that the S&P 500 were going higher, I think it's going lower. In this case, you might choose to sell bracket 4. Now, why would you want to sell bracket 4? Notice that if I'm wrong, it's got the lowest ceiling. So if it starts moving against me, I would get knocked out. Now, we have those brackets 2 and 3 in the middle where you're not so close so that you would get, what if you get knocked out and then the market automatically goes the way you wanted it to? It doesn't work that way. Once you get knocked out, you're knocked out. So if you were to get knocked out and you wanted to take the position again, you'd have to re-enter the position. So that's why we give you those choices so you can choose the level of risk versus reward that you're comfortable with. Now in bracket 4, if I were to sell, All right. I know where the ceiling was. Oh, what just happened there? There we go. My maximum risk when I sell would be if it were to go up and touch the ceiling, I know how much I could potentially lose. And if it were to go down, that's where I would make my profit. Okay, so notice when I'm selling, the red is up above and the green is below. When I'm buying, the green is up above and the red is below. And again, you would have to make a determination on where you would want to buy or sell between a knockout range where it makes the most sense for what you're trying to do, where you're comfortable with the risk versus reward ratio. Now, the capital requirements, when people trade other markets, you think about margin. The capital requirements for a Nadex knockout is the most that you can lose. That's it. The capital requirement, what you have to put up when you buy or sell an Nadex knockout is simply how much you have at risk, period. And that number will not change once you put on the position. That is it. You're not going to ever get a surprise margin call. You put up whatever you could potentially lose. That's what you have to put up in order to do the trade. And that never changes. And it doesn't matter whether you're buying or you're selling, right? Your maximum risk is what you put up for the trade. And we offer you multiple brackets so that you can decide how much you want to put up, how much capital are you willing to risk. What is it that you're willing to risk? You choose the bracket that fits your risk reward profile. That's why we give you 4 different choices. And that also helps 4 different choices, whether you are looking to buy or whether you're looking to sell, you've got a variety of choices to take into consideration. Okay, now on an order ticket itself, I just want to show you how simple and easy it is. Up top on the order ticket, you're going to have the price range. So here we are in the S&P 500, and if you look in the upper left-hand corner, you actually see where the current indicative price is up at 36.75. It's actually 36.74.85. We've got it. It's in between the range here, and there are going to be prices where you can buy and sell. All right, there's going to be a posted bid and there's going to be a posted offer, and you can sell at the bid price or you can buy at the offer price. You can also, this is something that differentiates Nadex from other markets out there, you can middle the market. If I want to try to buy and I want to put a bid in between, notice that I can choose my price. If I wanted to potentially buy at 36.74.50, which is between the bid ask spread, I could place an order to buy in between. Now, does that mean I'm going to buy it there? I don't know. Somebody would have to sell it to me, but you're allowed to post the price that you're willing to pay. You can put limit orders. You do not have to buy the offer or sell the bid. You can put a marketable order in between the bid-ask spread. You can even put them away from the bid-ask spread if you like. And notice that we do calculate. If you were to buy one at 36.74.50, all right, I know where the ceiling is. It's all the way up at 37.12. If it were to go all the way up there, I know that I could potentially make $375. We calculate that for you. If you were to buy one at 36.74.50 and it went down and touched the floor, 36.62. If it went down to 36.62, I would lose $125. I know going in exactly what I could potentially make, exactly what I could potentially lose, and my margin or my capital requirement to do this trade would be $125. I'd be putting up 125 to potentially make 375. Okay, so very small, and notice that adds up to 500. These are small contracts, and for posterity, this will trade right in line with the S&P 500. So if you, for instance, were an E-mini trader, this is going to trade exactly like an E-mini. That indicative price is the futures price. and that's exactly what we settle to, is the CME future price for the E-mini. And so you're essentially able to access price action. This is an example of the S&P 500, the E-mini, or the whichever, that's the S&P 500 future. And notice that what you would see, even though it's trading, it's the current price is 36.74.85. Notice how the bid ask is going to be right around that price. I mean, our bid ask, our spread is going to be right around approximately the price of the underlying index. That's what I mean by a delta one product. All right, so that's it. That's an order ticket. That's pretty clear. And unlike other futures contracts, say the E-mini, there's no initial margin and maintenance margin and margin calls. This is it. I can take price action. I can look for price action in the S&P 500 future, knowing exactly what I could potentially lose, exactly what I could potentially make in a defined risk, defined reward environment. That's what knockouts were built for. Now, I have not mentioned this yet. And that says an important rule when trading binaries, but that's an important rule when trading knockouts as well as call spreads. And this is an important rule when trading, period. It doesn't matter what you're trading. Is, well, actually not in some, anyhow. But at Nadex, an important rule when trading at Nadex, any of our contracts, just because there's an expiration associated with the contract does not mean you have to wait until expiration to see what happens. You can choose to exit the position early. All right. If you want, you can exit the position early. Now, why would you do that? You would do that to potentially lock in partial profit or to minimize losses. So in our knockouts, remember we had those 4 different brackets. What if you traded something in bracket 2 or bracket 3? All right, you had a little bit more room, you were a little further away from the floor and the ceiling, and you bought or you sold, and it starts going against you, and you change your mind. Your opinion changes. You can unwind it for a partial loss. You do not have to wait and experience maximum potential loss and wait for it to hit one of the floor or the ceiling. You can get out early. The same goes for taking a profit. It's going your way. A trade is going your way, and expiration is until the end of the week. You can either go, I'm looking to hit my maximum potential profit, or you can say, you know what, I'm willing to take a partial profit. Thank you very much. I'm going to, the saying is you can't go broke ringing a cash register. I'm going to take what I've made and then move on to another trade. So when you're trading Nadex knockouts, you can either wait for it to hit the floor or ceiling, or you can exit it early and take partial profits or minimize losses prior to expiration. If you take nothing else away from this session, take that away, please. Oh, and again, I wanted to mention, reach out to us, customer service at nadex.com if you've got any questions, anything about this presentation. I saw that people have been punching in a bunch of questions for Sophie in the background. Please continue to fire away. I am now going to jump over to our platform and do a very practical demonstration. Let me show you. All right, and you'll see it, and I think it'll definitely solidify what we've just gone through. By the way, I'm also going to put it out there. If anyone would like this slide deck, let Sophie know, let her know, and I'll make sure she gets a copy of the slide deck and she can send it to you. So if you're interested, put in your email, let Sophie know, and I will get it to her. She will get the slide deck to you. All right, now I'm going to change what I am showing you. Give me 1 second. All right. Okay, so something I wanted to do very quickly before we go over to the platform, because I think this is really cool. I mentioned to you follow us on YouTube. I am actually going to show you very quickly. I've just gone to YouTube here. If you're not familiar, I'm going to type in Nadex, and it will search for Nadex. And in fact, you're going to see us right here at the top. And when you come to our Nadex channel, you can subscribe to it. All right, please, I would recommend that you do this, but I'm also going to share with you something else that you might not be aware of. I am going to go to our videos. Now we've got playlists and you can scroll through. I am going to go to videos, and this is going to give you all of our videos, the newest ones first, and you can go through and you can find content this way as well. The reason I am showing this to you is we do something every morning that you might not be aware of. I am going to go to upcoming live streams, and you can see we will keep 2, 3, 4 of these every morning, 9 a.m. Eastern, 8 a.m. Central. For 10 or 15 minutes, we do a quick morning analysis and take a look at hot spots in the market, do a little technical analysis, look at some price action, and try to help you look at potential opportunities you might want to consider for that day. So if you were to subscribe to our channel, you could come here and actually set reminders for each one of these, and it would remind you when we're doing those, and you'll get an alert, but you just know 8 a.m. Central, 9 a.m. Eastern every day. In fact, here's the one that we did today. You can come and you can take a look at that later. This is also where you'll find a recording of this session. We will put it here. You'll even find it in our playlists on our homepage as well. So I wanted to do that. Now I'm going to, let's get rid of that. And now you should be seeing the Nadex website. I'm going to do one other thing because we've got some exciting things going on. If you go to the Learning Center of our website and you go to webinars, this is where you will find all of our upcoming webinars. This is also where we put our archive. So if you don't want to go to YouTube and you'd rather watch it on our website, all of our recordings are there. The reason I'm mentioning this right now, this is the session we're in right now, but this just went up and you're the first folks getting a look at it. We are going to run a day trading boot camp next Thursday. It's going to be a short education session. I am also going to tell you we're going to run a full-blown education day in January. So stay on the lookout. If you come here, it'll show up eventually down below when we post it. We'll be putting that up probably in a week. But the day trading boot camp next week, the little description hasn't come in, but it's going to be 3 sessions. And it's going to be kicked off by Guy Adami. He's going to do a whole session on the trader mindset. You can hear straight from Guy on how traders think, particularly day traders. I will be going over the products and tools that to access short-term price action, namely the Nadex products, binary options, call spreads, and knockouts. And then my colleague Dan Cook is actually going to go through some day trading strategies, taking knockouts, call spreads, binary options, putting them together in different ways for day trading. I wanted to put that out there. This is available. You can start registering for it. It is next Thursday. We will also record those sessions. All right, let's go ahead and log into the platform now. And I'm going to log in and let's go through. Now, if you've never been on our platform before, on the left-hand side are our products, binary options, call spreads, and knockouts, and we are going to just be focusing on knockouts. The positions tab at the bottom, and then the workspace where I will see my charts and order ticket once I get in there. Now, for knockouts, I'm going to go ahead and click on knockouts. Oh, you know something else? I'm going to see if I can do this. Yeah, I think that makes the screen a little bit bigger, and I think it'll make it easier for you to see. So something I always try to remember to do. All right, now, I mentioned in knockouts, we do have knockouts on indices. They are the US indexes. The US 500, which is the S&P 500, that would be for people looking to trade the E-mini. The US Small Cap 2000, it tracks the Russell 2000 future. All right, so if you're not familiar with Russell indexes, they've got the Russell 1000, very similar to the S&P 500, but it has the next 500 stocks. The Russell 2000 are the 2000 beneath that. So your mid and small cap stocks. And that tracks to the Russell 2000 future. The US Tech 100, that would be the Nasdaq. And then the Wall Street 30, that is the Dow Jones, the E-mini Dow. So the E-mini Dow, the E-mini Nasdaq, the E-mini Russell, these are all, but these are, I don't want to call them E-mini, these are even smaller, right? These are the notional value for each one of these is very small. As I mentioned for the S&P, it's a total of $500. Now, I am going to click on any one of these 4 contracts. As I mentioned, there's always going to be 4. And that will populate the chart. Now, I am going to slide, I'm going to hide this. So we just have a chart. I'm going to hide the positions pane. And I'm also going to clear my drawings. You know, while we're here, I think I should probably mention that we do have all of these tools. All right, let's shrink this in. Let's just get all 4 of them there. I want to make sure, let's pull this down a little bit. I want to make sure you can see everything as best as you can. Okay. Make it probably, okay. Now, notice one, you know what, let me just do this as a side note. We can set the time interval. Our charts are completely customizable. Let's just set this to a 15-minute chart. You can pick your range. We do have a bunch of technical indicators baked into the platform. If you don't know what these indicators are, there is a little I for in-platform education, something that differentiates us from other platforms. And if you wanted to, you know, I think we had Bollinger Bands on earlier. It's as simple as clicking on it, and it will populate your chart with that indicator. And if you wanted to customize it, you'll see where you can then customize how it displays, the periods, the ranges. You can set all the parameters. That is in our indicator section. If you're not certain, we got some education that tells you what the particular indicator is used for. We also have a variety of drawing tools for you to populate the chart. If you wanted to put on your own support resistance levels, trend lines, channels, you can put all of that on your chart so you can track your technical indicators to help you. For instance, and I'm just going to go ahead and just do a Fibonacci retracement. If you're not sure what Fibonacci is, there's some information. It's a ratio that's seen in nature, used in architecture, replicated in the human body. People tend to look for these patterns in the markets. If you wanted to draw a Fibonacci, we can see that we're in a downtrend here. Let's actually draw one. Fibonacci retracement. It's as easy as 1, 2, 3. I'm in a downtrend, so I start in the upper left-hand corner. If we were in the uptrend, I would do it the other way. I'd start in the bottom left-hand corner. I start up there. I come down to where the trend has been. I click a second time, and then I can extend it a third one, and it will give you some Fibonacci levels. I mean, this 50% retracement level, it kind of paused here and went through it, and then actually at the 23.6 was support. Right? When it rallied back up, that 50% was resistance. And then it really, it paused again at the 23.6 level, broke through it. And now you can see it's kind of range bound between this 38.2% level and this 23.6% level. Tools available to help you in your trading. Now, with knockouts, as I mentioned, we've got 4 different knockouts. Those are the 4 vertical blue lines that you see on the left-hand side of the chart. I can click on any one of those and it will draw on the chart the floor and the ceiling. So if I thought the S&P 500 were going to go higher from here, I could choose to buy any one of these. Now, which one? Notice that my risk reward is calculated on my order ticket. I chose one where the ceiling is very close and the floor is very far away, in which case, if I bought this and it fell, I've got a lot of risk. I got $411 worth of risk. But if it were to pop up just a little bit, I could potentially make $89. Now, is that the right one for buying? I don't know. Maybe you would want to choose something. Here, it's right between. Here's one where if you were to buy it, you're much closer to the floor. I'm going to click on buy here. Notice here when I buy one at this level, which is right around the, let's just make this an even number, 36.73. All right, if I were to buy one right here at 36.73 and it were to drop down and touch 36.62, right, so I bought it and it went down, I would lose $110. That's the most I can stand to lose. That little red section on my charts earlier, that would be right in here. That is what I stand to lose. What do I potentially stand to make would be if it went up. And if it were to go all the way back up to this 37.12 level where I would have maximum profit of 390. So on our charts, we give you very cleanly and clearly where the floor and ceiling are, and then you can choose which knockout suits your strategy, whether you're buying or selling, and how much risk you're willing to take for potential reward. Now, again, if I were to buy this, and let's just say I bought one, I'm going to go ahead and place an order between the market. I'm going to put one at 36.72.70. So let's just put one between the bid-ask spread, and I'm going to show you. All right. Oh, it went low. Let's put 40 in here, and I'm just going to go ahead and place my order. Notice there's my bid, 36.72.40. It tells me, oh, and I just bought it. I didn't even have a chance to show you. I was looking in my, it was an order, and since it executed, it's already in my positions, and it tells me I played 36.72.40. Now, what did I just do? My risk is if it goes down and touches the floor, which we tell you is 36.62, I would lose $104. If it were to go higher and get all the way up to 37.12, I would potentially make $396. Now, do I have to wait until expiration, which isn't for 1 day and 2 hours? Do I have to wait? No. Maybe I just want to take a short-term profit, and if I thought maybe this were going to go up to 36.80, okay, maybe I just, hey, I just want to take a quick little profit, and I wanted to place an order up above to sell it. I could try to sell it. Let's put in 36.80, which is above the market. That would be up here on the chart. All right. I can place an order to sell up there. It tells me I placed my order. And now when I look, I know I have my position where I bought it at 36.72.40. I'm sorry. Yeah, it's right. It's going against me. It's going down. I bought it at 36.72.40, but I'd like to sell it up at 36.80. Okay, I can offer it up above. Now, if it were to come down and touch 36.62, I would get knocked out of my trade and I'd want to go cancel my offer to sell it up above because I wouldn't want to do both. But the point is, I can exit the trade earlier if I want. I also showed you how to place a trade between the bid-ask spread. So you can do, it's very customizable to your trading style. I hope that has helped. I mean, it's pretty easy. I think it's pretty clear on our charts with our knockouts. It does make it. I love how we have the floor and the ceiling right on the chart, and that whether you're buying or whether you're selling, we calculate your maximum potential profit or maximum potential loss before you place the trade. Okay, before you even place the trade, it tells you what you could potentially make or lose. And again, as a reminder, you do not have to wait for it to touch one of these levels. You can choose to exit your position early. All right, I just want to take a quick little peek. Oh, I love it. So just to be clear, this was recorded. It will be available on our website as well as our YouTube channel. I see that some people have requested the deck from Sophie. That is great. I will make sure she gets a copy of the slide deck. If anyone else wants to get that in right now, if you forget or you want it later, please email customerservice@nadex.com, customerservice nadex.com. If you don't get the deck, we can make certain that you get it. You know what? There is a couple more questions I'd like to make clear. Just because these questions came in at the end, and I think there's some great questions. So let's talk about the one that I bought. The one that I bought at, let's go to my positions. I bought one at 36.7240. Okay. Now, it goes again, you know what? And this isn't even the contract that I bought. I believe this was the contract that I bought. Okay, good. Now, I bought this. If it goes down to 36.62 and I get knocked out, I would recognize maximum loss of $104. If it were to go up to 37.12, okay, I would get knocked out for maximum potential profit, $396. Now, if it were to go lower than 36.62, if it were to go down to 36.40, I could not lose any more than the 104 that I initially had at risk, because I would get knocked out right at this price. 36.62, there is no slippage. That's it. It touches 36.62, I'm out. I've experienced maximum potential loss. If it gets up to 37.12, as soon as it touches 37.12, I am out of the trade. The contract settled. I got knocked out for maximum potential profit. I made $396. If it goes up to 37.20, it doesn't matter. I cannot make any more than $396. This is how Nadex contracts work. Everything is defined risk, defined reward. Now, if I bought this and it were to go up to 37.12 and I got knocked out, but I wanted to stay long, I could simply go buy another knockout contract. I could pick the next knockout contract and just get into another trade. I could keep doing that. If I thought it were going to continue to keep going higher, I could absolutely do that. But my initial trade, I would get knocked out at the ceiling, right? Where, again, that's that discipline. That is that discipline where I bought this. If it goes against me, I don't want to be wishy-washy about where my stop is. I know exactly where it is. I also want to have a clear profit goal. And you need to know when to recognize profits too. It's both sides. That goes into the trader psyche, the trader mentality of it's minimizing losses, maximizing rewards, but knowing when to take your losses and knowing when to take your rewards. You know, what's the gambler song? I don't want to. You got to know when to hold them and know when to fold them. That's it. It is known commodity up front. So hopefully that was clear. All right, with that, I want to thank you all for joining. Again, this is being recorded. Sophie will get you those decks. Please register for our upcoming day trading boot camp. That is next week. You can get that on the Nadex website. Hopefully you can join us 9 a.m. Eastern, 8 a.m. Central every morning. We go for 10 or 15 minutes. If you miss it, the recordings are immediately available, and it gives you a little bit of analysis on what's going on in the market, hot spots in the market, to give you some trading ideas every day. We're here to help. Thank you for joining, and I want to wish everyone good luck in the markets.